Everyone thinks that low interest rates automatically drive property values higher. But during the Great Recession, when the Fed slashed rates to zero, commercial real estate still collapsed. Here's why.
The signs were everywhere, but now it's official. We are in a recession. The research group that makes that determination made it today and said the recession actually started a year ago. But the question now, when will it end? Wall Street is clearly worried. The Dow plunged nearly 680 points today, or 7.7%.
From 2007 to 2009, commercial real estate property values in the U.S. fell by as much as 40 to 50%. It was one of the sharpest and most widespread corrections we've seen in the modern commercial real estate era. And even though the Federal Reserve dropped interest rates all the way down to near zero, values kept falling. But why? Because interest rates are just one part of the equation, and they can't fix broken fundamentals. Let's break down exactly what happened.
This is going to be one of the watershed days in financial markets history.
It was a manic Monday in the financial markets. The Dow tumbled more than 500 points after two pillars of the street tumbled over the weekend. Lehman Brothers, a 158-year-old firm, filed for bankruptcy.
First, the credit markets completely froze.
Economist Mark Zandi says the credit markets are still frozen, and Main Street could feel the effects within weeks.
If they don't get relief from their bankers soon, meaning in the next few days, couple of weeks, they will be laying off workers and shutting operations.
In theory, low interest rates should have spurred borrowing. But in reality, it didn't matter because the banks had slammed the brakes. Lenders were not lending, not because they didn't want to, but because they couldn't. They were overloaded with toxic assets, bleeding capital, and just trying to stay solvent. Think about this. When your balance sheet is on fire, the last thing you're doing is issuing new loans. Credit committees became ultra-conservative overnight. Even well-qualified borrowers were getting declined. This wasn't about interest rates. It was about survival. Liquidity dried up, deal flow evaporated, and refinancing options disappeared. If you had a balloon payment coming due in 08 or 09, good luck. It didn't matter if rates were zero. If no one's funding deals, nothing moves. And without credit, commercial real estate stops. Transactions halt. Values drop, because in this business, when financing disappears, demand disappears right along with it. Second, cap rates skyrocketed. In normal times, when interest rates go down, cap rates tend to come down too. And that pushes property values up. But during the Great Recession, the opposite happened. Cap rates shot up fast. Why? Well, one word: fear.
I'm scared to close my eyes.
Investors were terrified. Confidence was gone. The financial system was breaking down, and nobody knew where the bottom was. So what happened next? The risk premium, the extra return investors demand for taking on uncertainty, surged. If you're buying a building and you're unsure if the tenants will survive, if the bank will finance it, or if rents will collapse, you're not paying a 5% cap rate. You want a 7, 8, or 9, maybe even more. And when that happens, values drop hard. Remember the formula: value equals net operating income divided by cap rate. So if the income stays flat, but cap rates go from 5 to 8, the building's value drops by nearly 40% instantly. And that's exactly what we saw. Cap rates widened across every major asset class. Buyers were on the sidelines, and those who were active demanded deep discounts just to justify the risk. Low interest rates could not offset that kind of fear. Because in a market where confidence has collapsed, debt is cheap, but risk is expensive. Third, net operating income collapsed.
According to the latest report from Reese, apartment rents continue to drop and vacancy rates remain at the highest level since 1980. Reese says actual rents paid by tenants fell the most year over year in Las Vegas, San Jose, California, and Phoenix.
In commercial real estate, value is driven by income. And in the Great Recession, that income dried up real fast.
All 567 stores are closing. Save as much as 30% off everything during the Circuit City going out of business sale.
Retailers were going bankrupt. Office tenants were laying off staff and abandoning space. Industrial users were slashing operations to bare bones. Entire floors went dark. Malls went empty. Vacancy rates spiked in nearly every major asset class. So what was the result? Rent rolls shrank. Lease renewals were delayed or renegotiated at lower rates. New leasing not happening. And across the board, landlords were suddenly collecting a lot less than they had just a year or two earlier. And here's the critical part. When NOI drops, property values fall. Not because of emotion, but because of math. If a building that once generated $1 million in NOI now brings in $600,000, and the cap rate, it stays the same, the value drops 40%. If the cap rate also rises, that's a double whammy. The value drops even more. This wasn't a paper loss, it was real. It hit every part of the market, Class A to Class C, gateway cities to secondary metros. You could not hide from it. Even landlords with little to no debt weren't immune, because when income falls, so does valuation. And for those who were over-leveraged, relying on short-term debt, that NOI decline was catastrophic. The crash wasn't just about cap rates or credit. It was about buildings that used to cash flow suddenly not cash flowing at all. Fourth, distressed sales flooded the market and they dragged everything down.
Foreclosures are up again, a whopping 81% from 2007 to 2008. More than 2.3 million American homeowners faced foreclosure proceedings last year.
In a healthy market, sales comparables reflect willing buyers and sellers making rational deals. But during the Great Recession, comps were anything but normal. Properties were being liquidated fast and often at a loss. Banks were offloading foreclosed assets. CMBS special services were dumping properties at steep discounts just to recover something. And the FDIC, it was auctioning off portfolios from failed banks, sometimes for pennies on the dollar. These weren't strategic sales, they were fire sales, driven by panic, pressure, and insolvency. And here's the real problem. Those distressed sales became the new comps. Whether you had a fully leased cash flowing building or a half-empty one, appraisers were forced to anchor their valuations to the only real sales in the market, and those were distressed sales. This meant that even stable buildings with solid tenants and good locations were suddenly worth 20, 30, even 40% less on paper. Not because the building changed, but because the market around it collapsed. It created this vicious cycle. Lower comps led to lower valuations, which triggered more loan defaults, more foreclosures, and more distressed sales, pulling prices even lower. This wasn't just a correction, it was a chain reaction.
Those neutrons bombard other uranium atoms, causing them to split and split still others. The result? A chain reaction.
And for owners who weren't forced to sell, they were stuck, unable to refinance or access capital because the appraised value of the building no longer supported their debt. Distressed sales didn't just reflect the crash, they deepened it. And last, fear ruled everything. This wasn't just an economic crisis, it was a psychological one. The entire system felt like it was unraveling. And when that happens, logic and spreadsheets go out the window. Emotion takes over. Investors, they weren't chasing deals, they were in defense mode. Everyone was preserving cash, protecting balance sheets, and waiting for someone else to make the first move. It didn't matter how low rates were, it didn't matter if you had access to debt, because no one wanted to buy into a system that looked like it was collapsing in real time. Think about it. Would you buy a building when tenants are defaulting, banks are failing, and yesterday's values mean nothing? the phrase catching a falling knife became the mood of the market.
No, 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 not this fucking time, no fucking way, no fucking way, no fucking way, no fucking way, you made me look a right cunt.
Capital was still out there, but it was on the sidelines. Institutions were watching, not acting. Developers paused. Private equity sat tight. Even the most seasoned investors were saying, let's wait and see where this thing shakes out. And as fear took over, the market just stalled. Transaction volume dried up, pricing became impossible to pin down, and until confidence returned, no amount of cheap debt could bring buyers back into the game. Because real estate isn't just driven by interest rates, it's driven by investor confidence and conviction. And in 2008, confidence and conviction had left the building.
Elvis has left the building.
So what did we learn from all this? Yes, the Fed slashed rates to zero, but it wasn't enough because commercial real estate doesn't run on cheap money alone. It runs on confidence, income, credit, and risk. And in 2008, every one of those pillars collapsed. That's why property values plummeted, not because of interest rates, but because the foundation cracked. What's the lesson here? What can you take away from this? Without strong fundamentals, low interest rates mean nothing. If the engine isn't working, more fuel won't get you anywhere. I'm Brandon Michaels. I've sold billions in commercial real estate and I've helped hundreds of property owners achieve their financial goals. And I'm here to help you understand how the market actually works. Follow for real insights that help you think like an investor, not just a headline reader.